If you look at the net worth of Warren Buffett today, it sits somewhere around $130 billion. But here is the most important, least talked about fact in all of finance. Warren Buffett made over 99% of his wealth after his 50th birthday. He is not a billionaire because he found a secret stock that shot to the moon overnight. He is a billionaire because he was a consistently good investor for 3/4 of a century. This simple truth destroys the modern illusion of wealth creation that floods social media every single day. We are constantly bombarded with images of overnight success, cryptocurrency millionaires, and day traders promising the secret to instant riches. But the reality of true generational wealth is incredibly boring, painfully slow at first, and ultimately relies on a mathematical phenomenon that anyone can harness, but very few have the patience to see through. His secret is not timing the market. His secret is time in the market. It is a concept called compound interest, and while it sounds like a boring secondary school maths lesson, it is the only reliable, completely legal, and non-scam way for an ordinary person to build life-changing wealth. The human brain is actually wired to misunderstand compounding. We think linearly. If we take 1 step, we move 1 pace. If we take 10 steps, we move 10 paces. But compounding is exponential. If you take 30 linear steps, you move 30 paces. If you take 30 exponential steps, where each step doubles the distance of the last, you would walk all the way to the moon and back. This fundamental misunderstanding of exponential growth is why so many people give up on investing just before the massive gains begin to materialize. To understand why compounding is so powerful, but also why so few people actually stick with it, you have to look at the magic penny experiment. If you are offered £1 million in cold hard cash today, or a single penny that doubles in value every single day for 31 days, the human brain naturally gravitates towards the million. It is immediate, it is tangible, and it solves immediate problems. The penny feels like a joke. If you take the penny, day 1 gets you 1 penny. By day 5, you have 16 pence. By day 10, you have £5 and 12 pence. At this point, 10 days in, you are probably feeling incredibly foolish. You could have been a millionaire, and instead, you can barely afford a sandwich. Your money is barely growing. This is exactly why ordinary people quit investing. They put money into a sensible fund. They look at their portfolio after a year or two. They see a few £100 of profit, and they think this is far too slow. This is not working. I need to try something riskier. But if you hold on, the mathematics take over. By day 20, you have over £5,200. It is getting better, but still miles away from $1 million. Then the back half of the curve kicks in. By day 25, you have over £167,000. By day 28, you cross the £1 million mark. And by day 31, that single penny has compounded into over £10.7 million. Compounding is entirely backloaded. The massive, life-changing growth happens at the very end of the timeline. You are building a snowball, and to build a massive snowball, you do not need a lot of snow. You just need a very long hill. Warren Buffett started rolling his snowball when he was 10 years old. His hill is over 80 years long. That is the entire secret. Let us look deeper into the mechanics of this snowball. The true engine of compounding in the stock market comes from something called dividend reinvestment. When you own shares in the biggest companies in the world, they often pay you a share of their profits simply for owning the stock. These are called dividends. An amateur investor might take those dividends and spend them on a holiday or a new television, but the wealth builder takes those dividends and immediately uses them to buy more shares. Now, the new shares produce their own dividends, which buy even more shares. It is a self-feeding loop. You create an army of worker bees, they go out and gather honey, and they use that honey to create more worker bees. After a few decades, you have an unstoppable swarm generating wealth while you sleep. There is a mathematical shortcut to help you visualize this, known as the Rule of 72. If you want to know how long it will take for your money to double, you divide the number 72 by your expected annual interest rate. If you expect an average return of 8% a year, which is a reasonable historical expectation for the global stock market, you divide 72 by 8. The answer is 9. This means your money will double every 9 years. If you invest £1,000 at age 20, it becomes £2,000 at age 29. It becomes £4,000 at age 38. It becomes £8,000 at age 47, and £16,000 by age 56. You did absolutely nothing but wait, and your purchasing power exploded. Let us take this out of the theoretical world and apply it to an ordinary life in the United Kingdom. We are going to look at 3 completely normal people, Sarah, James, and David. They all earn the UK median salary of around £3,500 a year. They face the same high energy bills, the same expensive housing market, and the same cost of living pressures. Sarah learns about compounding early. At age 25, she decides to prioritize her future self over immediate gratification. She starts investing £200 a month into a globally diversified index fund inside a stocks and shares ISA. She does this for just 10 years, stopping exactly at age 35 because she wants to start a family and needs the extra cash flow. Her total out-of-pocket investment is £24,000. She never adds another penny from her own bank account, but she leaves the money invested, untouched, until she is 65. James waits. He spends his 20s and early 30s living paycheck to paycheck, assuming he has plenty of time to worry about retirement later. At 35, realizing he is severely behind, he starts investing the exact same £200 a month. But James cannot stop. He invests £200 every single month for 30 solid years until he is 65. His total out-of-pocket investment is £7,200. Then we have David. David thinks investing £200 a month is too boring. He wants to beat the market. He saves up £24,000 by age 35, much like Sarah, but instead of buying a boring index fund, he day trades. He buys individual tech stocks, he dabbles in highly speculative assets, and he constantly moves his money around trying to time the market peaks and troughs. Research shows that active retail traders like David almost always underperform the broader market, often losing money to fees, bad timing, and emotional decision-making. Let us be generous and say, David manages a 4% return over his lifetime because he constantly interrupts his own compounding by selling out of fear and buying out of greed. Assuming a historical average return of 8% for Sarah and James, let us look at the final numbers at age 65. James, who invested £7,200 over 30 years, ends up with around £29,800. Sarah, who invested only £24,000 but started a decade earlier, ends up with around £36,800. David, despite putting in massive effort, stressing over daily charts and trading constantly, ends up with around £77,000. Sarah beat James by £7,000, despite putting in a third of the effort and a third of the money. She beat David by hundreds of thousands of pounds, despite never once reading a financial report or checking a stock chart. Why? Because her money had an extra decade to compound. The profit her money made began making its own profit. Time does the heavy lifting, not your salary, not your intelligence, and certainly not your ability to guess what the stock market will do tomorrow. If the mathematics is this straightforward, why is not everyone in the UK retiring wealthy? Why do so many people reach retirement age entirely dependent on a state pension that barely covers basic heating and food? It is because an ordinary investor faces massive, silent enemies that are constantly trying to melt their snowball before it can gather momentum. Understanding these enemies is just as important as understanding the maths. The first enemy is the fee trap. The financial industry is a masterclass in wealth extraction. They make billions by making investing look incredibly complicated so they can charge you for navigating it. If you use an expensive fund manager or a flashy financial advisor charging a 2% annual fee, it sounds relatively harmless. 2% is a tiny number, but over a 30-year investing lifetime, that 2% fee will devour nearly 40% of your potential total wealth. It is a parasitic drain on your snowball. Warren Buffett famously won a $1 million bet, proving that a boring, low-cost index fund will mathematically beat a group of highly paid hedge fund managers over a decade. The hedge funds charged massive fees. The index fund charged almost nothing. Over time, the lack of fees allowed the index fund to compound far more aggressively. The rule for an ordinary investor is brutally simple. Keep your fund fees under 0.3%. Every pound you save in fees is a pound that stays in your account to compound for decades. The second enemy is the silent tax of inflation. Keeping your life savings in a high street bank account feels incredibly safe. You can log into your banking app and see the exact number. It never goes down. But it is actually a guaranteed loss of purchasing power. Inflation is the gradual increase in the price of goods and services. If inflation is running at 4% and your savings account pays you 2%, your money is actively dying. You can buy fewer groceries, less petrol, and less electricity with it this year than you could last year. Your wealth is evaporating in plain sight. To preserve and grow your wealth, your money must be invested in productive assets. When you own shares in global companies, you own the very businesses that are raising prices to match inflation. As their prices go up, their revenues go up, and the value of your shares goes up. Investing is not a risky gamble. It is the only viable lifeboat against the rising tide of inflation. The third enemy is human psychology, and this is the most destructive enemy of all. You are the biggest risk to your own money. The stock market is inherently volatile. It goes up and down. It crashes. It drops by 20%, 30%, sometimes even 50% during severe global crises. It has done this throughout history, and it is an absolute mathematical certainty that it will do it again in your lifetime. When this happens, ordinary investors panic. They watch the news. They hear stories of economic doom. They log into their investment apps, see a sea of red numbers, and they sell everything to protect what is left. By selling in a panic, they permanently interrupt the compounding process. They turn a temporary paper decline into a permanent, devastating loss of capital. The legendary partner of Warren Buffett, Charlie Munger, once said that if you cannot stomach a 50% decline in your investment portfolio without panicking, you do not deserve the long-term rewards of the stock market. When the market drops, it simply means that shares in the best, most profitable, most resilient companies in the world are on sale. You do not panic and run out of the supermarket. When everyday items are discounted, you load up your trolley. You should not panic when stocks are discounted either. You must train your brain to view market crashes as opportunities, not disasters. Boring is profitable. Excitement is expensive. Let us expand on why the human brain struggles so immensely with this concept. Throughout human evolution, our ancestors survived by prioritizing immediate needs. If you found food, you ate it immediately because it might spoil or be stolen. If you saw a predator, you ran. Our brains are hardwired for short-term survival, not long-term planning. We are chemically rewarded by dopamine when we achieve instant gratification. When you buy a new piece of clothing or a new gadget, your brain gives you a hit of joy. When you lock your money away in an index fund that you cannot touch for 30 years, your brain gives you nothing. It feels like a sacrifice, a loss of resources. Overcoming this primal instinct is the single hardest part of becoming a successful investor. You have to intellectually override millions of years of evolutionary programming. You have to convince your brain that the delayed reward will be exponentially greater than the immediate dopamine hit. This is where the concept of the Stoic investor comes into play. The most successful investors in the world share a common trait: emotional detachment. They do not view their portfolio balance as a measure of their current self-worth or an available pool of spending money. They view it as a separate entity entirely, a machine that is under construction. When you are building a house, you do not tear down the half-built walls to sell the bricks just because you want a quick influx of cash. You let the construction finish. Your investment portfolio is exactly the same. It is a structure being built over decades. Every time you panic, sell during a market dip, or withdraw funds to buy a depreciating asset like a car, you are tearing down the walls of your own financial house. Consider the historical context of the stock market. Over the last century, the world has faced world wars, devastating global pandemics, severe economic depressions, hyperinflation, geopolitical crises, and countless political upheavals. During every single one of those events, there were people who claimed the financial system was ending and that investing was an errand for fools. And yet, despite all of that chaos, the global stock market has relentlessly marched upwards over the long term. Human innovation, the desire for progress, and the fundamental drive of businesses to solve problems and generate profits have always overcome short-term crises. When you invest in a global index fund, you are essentially placing a bet on human resilience. You are betting that tomorrow will eventually be better than today, and that companies will continue to invent, adapt, and grow. Betting against the stock market over a 30-year period is essentially betting against the advancement of human civilization. Let us also address the modern distraction of cryptocurrency and meme stocks. In recent years, a new culture of investing has emerged, driven by social media algorithms that thrive on outrage and extreme excitement. We see stories of individuals turning a few £1,000s into millions by buying digital coins named after dogs, or by coordinating mass purchases of failing retail companies. These stories are modern lotteries. For every one person who timed the bubble perfectly and got rich, there are thousands of silent individuals who bought at the peak and lost their entire life savings. This is not investing. This is gambling. It relies on finding someone else willing to pay a higher price for an asset that produces no intrinsic value, no dividends, and no actual business revenue. True wealth building focuses on productive assets. A farm produces food. A factory produces goods. A software company produces efficiency. When you buy shares in these entities, your wealth grows because the underlying value of the business grows, not just because you hope another trader will buy it from you at a higher price tomorrow. Building this unbreakable financial fortress requires absolutely zero Wall Street knowledge. It does not require a degree in economics. It requires a brutally simple, highly boring system executed with relentless consistency. Let us break down the exact steps an ordinary person in the UK must take to activate this process. First, you must clear toxic debt. Compounding is a universal law of mathematics, and it does not care whether it is working for you or against you. If you are paying 20% interest on a credit card balance or a high-interest personal loan, you're experiencing compound interest working against you. No investment in the world will reliably beat a guaranteed 20% loss. You must aggressively attack and eliminate all high-interest debt before you even think about buying stocks. Stop the bleeding before you start building. Second, you must build an emergency buffer. Before you send your money off to work in the global markets, you need a shield. This is 3 to 6 months of basic living expenses sitting in an easy access savings account. This is not an investment, this is insurance. When the boiler breaks, when the car fails its inspection, or when a sudden redundancy happens, you use this cash. Without an emergency fund, the moment a crisis hits, you will be forced to sell your investments at the worst possible time, interrupting your compounding process. Third, utilize your UK tax wrappers. The UK government provides one of the greatest wealth-building tools in the world, the Stocks and Shares ISA. Every single adult resident in the UK gets a £20,000 allowance each tax year. Any investment you buy inside this account, and every single penny of profit, dividend, or capital growth it generates, is completely, legally protected from capital gains tax and dividend tax forever. If your investments grow to £1 million inside an ISA, you can withdraw the entire amount, and the taxman cannot touch a single penny. It is a legal tax haven for the working class. You must use it. Fourth, buy the haystack. Do not try to find the needle. Do not try to pick the next winning stock like Apple, Tesla, or Nvidia. The graveyard of retail investing is full of people who thought they could outsmart the market. Instead, buy a broad, low-cost, global all-cap index fund. This is a single fund that holds a microscopic fraction of thousands of the biggest companies across the entirety of the globe. You will own a tiny piece of the technology sector in America, the manufacturing sector in Japan, the pharmaceutical sector in Switzerland, and the banking sector in the UK. If one company goes bankrupt, it is irrelevant because the thousands of others carry you upwards. You are no longer betting on a single horse. You are buying the entire racetrack. You are betting on human progress, and historically, human progress always moves up and to the right. Finally, automate that entire process and look away. Discipline is a finite resource. If you rely on your own willpower to manually log in and invest money every month, eventually, you will find an excuse not to. You will decide you need the money for a holiday or a new phone, or you will get scared by a news headline. To guarantee success, you must remove human error from the equation. Set up a direct debit for the day after your payday. Whether it is £50, £100, or £500, let the money leave your current account automatically before you even have the chance to see it or spend it. Treat it like a tax that you owe to your future self. Once the automation is set up, delete the investment app from your phone. Do not check your portfolio every day. Do not check it every week. Maybe check it once a year just to ensure the direct debit is still functioning. The less you look at your portfolio, the richer you will become. You must let the businesses of the world work for you in the background while you focus on living your actual life. Go for a walk, spend time with your family, focus on your career, and let the mathematics do the heavy lifting in silence. Ultimately, the concept of compounding is not really about money at all. If you look closely at the life of Warren Buffett, you will see a man who does not care about the superficial trappings of wealth. He does not live a wildly flashy lifestyle. He does not own a fleet of super yachts. He still lives in the exact same house he bought in Omaha back in 1958 for a fraction of what he earns in a single minute today. He eats at standard diners and drives incredibly normal cars. So why did he spend 80 years building a $130 billion snowball? Because compounding is about buying freedom. It is the ultimate form of self-determination. Money, in its purest form, is simply stored energy and stored time. When you build wealth through compounding, you are buying back your own future. It is the absolute reassurance that when you are 55 or 60 years old, you do not have to stay in a job that makes you miserable just to pay the heating bill. It is the ability to dictate your own schedule, to wake up every morning and decide exactly what you want to do with your day. It provides the security to help your children get a head start in life, the ability to weather any economic storm without anxiety, and the profound peace of mind that comes from knowing you are entirely self-reliant. Compounding allows an ordinary person with an ordinary salary to build an extraordinary level of independence. It is about letting the immense, unstoppable machinery of the global economy work tirelessly for you, rather than spending your entire existence working just to survive the economy. The math is proven, the tools are available, and the only variable left in the equation is your willingness to begin today and your patience to let the years do their work. The time will pass anyway. You might as well let it make you wealthy.